Jerry, it's always good to see you. Welcome back.
Good to see you, Tyler.
Since we were just talking about Nvidia, you like them. Why?
Yeah, I mean, it's one thing to have a dominant market share in a good business, but one that every day almost, it seems, has some new stair-stepping growth. I mean, he didn't even mention the fact that, Facebook has doubled its cap spending all around things that GPUs are so critical for, and the fact that Nvidia's got a 2 or 3 year lead over anybody in the space. I mean, it's going to be a while before we understand how big this market is, and right now they own it.
And it's a company that's, what, $800 billion in market capitalization. Let's talk a little bit about Ford, another company that you like. I think it was a choice of one of the members of our stock draft a few months ago. I remember Jim Cramer being very positive on it. This company has been going and going and going. Yesterday, I guess it was, GM announced an EV partnership, charging a partnership with EVgo. Ford is in that game. Why do you like Ford?
Okay, real quick. This is a company, and the whole industry was considered, at best a cyclical, right? 10 times earnings. The cycle comes and goes. In this pandemic, the entire global economy paid Ford and GM a great favor by telling them they didn't have to promote anything. They could run at much lower capacity and build cash on their balance sheet. The cash that they've built now over these 3 years is going to fund all of their transition into EVs. And I don't know about you, but as interesting as Rivian's going to be and some of these other products, the F-150 is the most popular thing on wheels ever. And they're going to have the electrified version of it. And they have showrooms all over the country. I feel like the difference in valuation between Ford and Rivian and Tesla is too great for us to sit here and quibble about when this gets going. It's here. It's now.
It's also interesting, Jerry, that you say you think the valuation gap will be closed between some of the energy and value companies, if you want to call it that, and tech. You don't hate tech. You have Microsoft, MasterCard, Nvidia, and the likes. But what do you mean in terms of the room to run that we could see for names like Diamondback and EOG?
Yeah, thank you for asking that. So, again, one of the transition problems in this next cycle is the fact that we've so cut back on the amount of oil and gas development spending we're doing that we're just going to need to price demand out, meaning we're going to have to see oil over $100 a barrel before we even begin to touch the imbalances there are on the supply side. So that's going to leave company like EOG and Diamondback. I mean, they're going to throw off 30% or more of their market cap in free cash over this next 5 years. It just is so powerful. And when you have a business that has that type of free cash generation, generally you see it in share buybacks and in dividends, and you have a great support for the stock throughout the entire phase. And so I think you're going to see a whole different view of these kinds of energy producers that have low cost base and high cash flow. And it'll be another example, like Ford, of an old cyclical business that gets upgraded, if you want, into a much better valuation profile.